a good, fundamentally strong company look like? What is a price to earnings ratio that seems fair? I know this looks bad on my eye, it's just allergies. We're going to use Google as an example, and I'm going to go through everything that's available right here on my own fundamental analysis template. And if you're sitting there going, whoa, how do I get that template? All you have to do is go right here, click on the menu, and all of these options that pop up are free. But what you're looking for is this one right here, the fundamental analysis template. And we're going to fill it in. Well, I already have. And I'm going to walk you through where I get all this information as well. So come with me. So I mostly use two websites to get all of this information. The first one is Seeking Alpha, and the second one is MarketWatch. So right here you can see Google's 1, 5, and 10-year performance. This is positive, right? It's gone up a lot in the last 10 years. Next thing we want to find is their market cap. How much is the company worth? And you can see that right here. They are worth $2.03 trillion. Next up is the dividend, if the company offers it. And you can see that Google has one, but it's relatively new and it's not all that great, but it's still something. And the dividend is listed right here. But what about the dividend safety grade? If you click on dividends right here, it'll take you to their safety grade. And look at that, Google's dividend is too new to have a safety rating. By the way, this feature is only available with their premium subscription. There's a link in my bio if you want to try it. Up next, we have the price to earnings ratio, which was also in your question, what is a good price to earnings ratio? Now you can see here that the price to earnings ratio for Google is 17.39x or times earnings. This is called the price to earnings ratio. It's also called the multiple. It compares the price of the stock to the company's earnings. And the industry average is just around 13 times, which makes Google a little bit overvalued. It is listed right here, 17.39. And if you go right up here to valuation and you find the one that's 17.39, it'll show you the sector average right next to it. There isn't really a good or one size fits all price to earnings ratio where this number is great and this number is bad. It really kind of depends company to company and sector to sector. So for example, some new growth companies might be extremely overvalued, but investors don't care. They're willing to pay for that premium because they think the company will become more profitable later. But generally, the higher the price to earnings ratio, the more overvalued it is. Usually companies fall between anywhere from 20 to 50 is a reasonable price to earnings ratio. But if you see something like this, here we are looking at Tesla, and you can see their price to earnings is 179 times earnings. That means the stock is trading at 179 times earnings, whereas the sector median is 16. This means Tesla is wildly overvalued. An overvalued stock means that if anything goes wrong with the company, it could tumble dramatically, whereas an undervalued stock is kind of the opposite. It's like maybe a diamond in the rough. Oh, look at this. This company is extremely undervalued compared to their competitors. Maybe there's a possibility here. On the other hand, it could mean that the company just straight up sucks. For revenue, which is up next, we just scroll down on Seeking Alpha yet again, and you will find this tab right here, which has the annual revenue going back from 2020. And look at that. The revenue is increasing every single year. And look, they also have estimates for 2025 and 2026. And the revenue trend of growth continues. This is very positive. To get a deeper dive on things like net income, total assets, long-term debt, I like to go to MarketWatch. And if you go right up here to the stock's homepage and you click on financials, you will see income statement, balance sheet, and cash flow. And when you're doing your homework and you're filling out this template, you'll notice, for example, net income, $100 billion. But if we go back here and we look, we want to see that net income is increasing over the years. And with this one minor pullback, probably COVID related, let's see. Yeah, 2022 could have been just coming off of COVID. We can then see that their net income continues to improve. This is very good. Net income, by the way, is the final profit after all other expenses have been subtracted. So you want that number to go up. Debt is a tricky one. If it's a growth company that's posting solid revenue growth and their debt is also increasing a little bit, that's okay, because sometimes you got to take on a little bit of debt if you're going to grow. On the other hand, paying off the debt is great. And you can see here that Google's debt is actually dropping. Their cash flow is pretty strong, their free cash flow is good, and their 1-year price target has a 20% upside. A lot of people write me and they go, I filled out the template, I can't make any sense of it. Sure you can. Are the good numbers going up? Are the bad numbers going down? Is the dividend increasing? Has the stock gone up? These are all very simple things to understand. It only takes 5 minutes to fill this thing out. People often ask me, especially when I go live, what do you think of this one? What do you think of that one? Can you tell me your opinion on this stock? My opinion doesn't matter. I could like it, I could hate it. It doesn't matter what I think. What matters are the fundamentals. Learn how to do it and you won't have to ask me my opinion on anything.